Hello traders, welcome to today's new video series. I am Sanjay from Tribe International. This session is powered by Tribe Hub, a place for all financial education. An initiative by Tribe will dive into the exciting world of Forex trading with technical analysis. Whether you are a beginner or experienced trader, understanding the basics is always crucial. The series is designed in a way that anyone with no knowledge about trading can learn in very simple way about technical analysis and apply that knowledge into reading forex chart and take trades based on it. So let's get started. What is Forex? It's a short form for foreign exchange. Forex is a global marketplace where currencies are bought and sold. For example, you visit a foreign country and on airport you exchange your Indian rupee currency into dollars at the rate of 80 rupees, and upon returning you exchange again and sell those dollars at 84 rupees. So that 4 rupees per dollar is your profit. Similarly, in forex market, you can buy and sell any currency at the convenience of just one click. How big is forex market? Well, it's the largest financial market with a daily trading volume of $7.5 trillion on an average. If you compare it with Nasdaq or any other Indian stock exchange, then they are just around $19 billion per day. So you can imagine the money flowing into the forex market. Forex market runs 24 hours and 5 days a week. In forex, you trade currency pair. For example, Euro USD, European currency versus American dollar. So it represents the first currency is Euro, and which is also a base currency, and the second is USD, and we call it a quote currency. The prices are fluctuating based on supply and demand in the market. A currency pair on the trading market is the main tool for an offer to buy or sell a currency. A currency pair consists of two currencies, as I mentioned, base and quote. But let's understand what is base and quote and how will you differentiate it. So the base currency is the first currency listed in a currency pair. In this case, Euro will be the base currency because the name is in first here. For instance, in Euro USD, the Euro takes the lead. When you see a rate like this for Euro USD on the market, then it means for 1 euro equals to $1.10. The base currency is your starting point, the one you are assessing or trading against the other one. Quote currency, similarly, in Euro USD, US dollar plays this role of quote. When you see the price 1.1000 on the market, it tells you how many dollars you need to purchase 1 euro. The quote currency is your measuring stick, the one you are comparing the base against. So base currency is the leading currency and quote currency will be your following currency. And of course, the prices on the charts will be reflection of this currency's value. Now, there are several major currency pairs. So what are those? Major currency pairs are Euro USD, and also major currency means which have the highest trading volume in forex. So these 7 currencies have the highest trading volume. Second one is USD versus Japan, or you can see their nicknames here also. The third one is UK versus US, US versus Switzerland, USD versus Canada, Australia versus United States, New Zealand versus US. So you can see here every pair have USD in common because USD is the highest trading currency, plus it is valid all over the world. These major currencies includes 75% of the total volume globally generated in Forex. So there will be no problem of liquidity in these major pairs. In addition to major currency pairs, there are some more currency pairs. So let's see what are those. We call them minor currency pairs or cross currency pairs. It means a pair which does not have US dollar in it. Back in the days, what was happening is, if you want to convert your currency into some other currency, then what you have to do is convert currency you have into the US dollar, and then only you will be able to change those dollars into the currency you want. So the US dollar was known as a vehicle currency, since the currency was used as a medium of exchange for international transaction. USD is a widely accepted currency. The lengthy process of converting currencies into other currencies other than US dollars, it was very lengthy. To reduce that, minor currency pairs were introduced. For example, if a person want to change their UK currency into Japanese yen, then what they have to do is they have to convert their UK into US dollars first, and then those dollars will only be converted into Japanese yen currency. So you can see the problem here. So this minor currency pairs or cross currency pairs, they solve that lengthy problem, and there are minor currency pairs available to trade. Of course, they have less volume than the major currency pairs, but they do the job. Euro has several currency pairs within it, and so does the Japan, US, India, Canada, Australia and New Zealand. And there are many more, like in total there are 128 around currency pairs available to trade in the Forex market. Now that we have known about Forex size, currency pairs available to trade in, let's see what are the trading hours that suitable for any person to trade in, because the Forex is open 24 hours. Forex market operating hours. Unlike traditional stock markets, which runs for 5 to 6 hours a day, the Forex market operates 24 hours a day and 5 days a week. It is true that you can trade Forex anytime you want, but that does not mean that it's always active the entire day. Best time to trade Forex when the multiple trading sessions are active across the globe. You can see here, New Zealand market opens at 3:30 am and it ends at 10:15 am. Similarly, the Australian market opens at 5:30 and ends at 12:30. So these two markets are overlapping in between this time. So what is this? Till 10, and the starting point is 5:30 am. So at this time these two markets are active. Another one is Japan. Japan is active from 5:30 to 2:30. So you can see this time from 5:30 to 10 am the volume will be very high in this session, and this is one more session overlapping, which is Hong Kong and Singapore. So of course it will combine up to a very huge volume. But during this Indian session, which have initially when these three sessions are overlapping, so of course for Indian players the best time to trade in is from 9 am to 2:30 pm. and then after that Germany session is not overlapping too much, but it is overlapping with the Indian market, and similarly UK session is also overlapping, and the US market is overlapping for just few hours. So of course for India, this last period from 5:30 to 7:30, it will be the most active time. So remember that best time to trade Forex when multiple trading sessions are active across the globe and overlapping, creating a spike in trading activity, because it increases the volume as many participants all over the globe starts transacting at a particular time. 5:30 to 7:30, a lot of sessions are overlapping, and the most important one is the US market, because US market have very high volume in it, so that is overlapping with the Indian time, which gives the most active session. Till now we have discussed how you can trade the Forex and when you should trade the Forex. Now let's understand what are the benefits of Forex and why you should trade the Forex markets. So what are the advantage of Forex markets are zero to no commission, because most brokers make money by spreads. Unlike other stock markets, they charge brokerage from you. Second advantage is very high leverage compared to stock or any other asset. Leverage means margin, the power to play in a very big amount with having very less amount in your account. So let's say if you can control 1 lakh rupees with just having 1000 in your pocket, then imagine the profit you could make here, or even loss you can make here, because leverage is a double-edged sword. If it's making your day, then it can typically turns your day off too, because leverage can make money and it can wipe out money you have also. So be cautious when using a very high leverage, but it's good when you know what to do in the markets. You can benefit from the high leverage provided in the Forex. Easy entry, you can start trading in Forex within a few minutes. You can open your account with Thrive and it will get active within just few minutes, so you have very less entry barriers here. You can trade whenever you like, because the time is not fixed in Forex, and the markets are almost running 24 hours and 5 days a week. And in Forex you have flexible lot size. You can trade with smallest lot size in major currency pairs. The Forex market is very big, so it is very hard for any operator or big player to manipulate the markets to fluctuate wrongly. Of course, it have very deep liquidity. However big position you have, it does not matter. It will get executed flawlessly, because the buying and selling is constantly going on in the markets. Till now, we have discussed what to trade in Forex, when to trade in Forex, and the benefit of Forex trading. Now, we will understand the techniques used in Forex analysis. Majorly, there are 3 techniques used in Forex analysis. The first one is fundamental analysis. Fundamental analysis is focused on fundamental events happening in a particular economy. For example, economic indicators such as GDP data, inflation rate. Those factors have a direct impact on the price of country's currency. Studying those events can give you an opportunity to trade in Forex. Similarly, geopolitical events and Forex reserve data can also have a significant impact on the price of currency. So, a fundamental analyst evaluate those factors and draw a conclusion to identify trading opportunities in Forex market. The second type of technique is technical analysis. Technical analysis is usually a short-term analysis which gives you very good short-term opportunities in comparison to the fundamental analysis, because the fundamental events have a longer term horizon. But technical analysis is a study of price activity on charts, and it includes volume analysis that results in the price data you are reading on a chart reflects the trader's psychology, what mass traders are thinking. So that is reflected on the charts with the help of chart patterns, and those chart patterns convey a message. That message could result in an opportunity to trade into forex markets. Similarly, there are some indicators are also there that can help you understand that what price is trying to say, and by considering all these factors you can have some good trading opportunities with a probabilistic approach in the forex market. The third type of analysis is quantitative analysis, which is used by high frequency trading firms and big institutions because they are mathematical and statistical approach. The quantitative analysis is done through complex formulas that are put up in a software, and that software is buying and selling forex currencies within a very short period of time. So these formulas are complex and it requires good infrastructure to trade in, like algorithm tradings. So usually big mutual funds, banks, trading desks or big institutions like FIIs uses this kind of quantitative analysis, and in quantitative analysis they are trading with very high volume for a very small movement in the price. As they have a high quantity, a high volume, so they are targeting few pips in the forex market, and that results in huge profits or loss. The orders they are trading per day are in a very high quantity because the system, the software punch in trades very frequently. So in this video we are going to focus on the technical analysis aspect in detail. What is technical analysis? Technical analysis is a technique to identify trading opportunities in the market through the study of historical price movement on chart. So majorly you can say it is a study of historical price. I will explain you why we are studying the historical price. Over a period of time on price chart, some patterns are formed. It is not deliberately someone's action, but it's a collective action of all of the traders available in the market, and those patterns convey a message. And as a technical analyst you have to understand that what particular pattern is saying to you and identify trading opportunities and take a monetary benefit out of those patterns. What are charts? Let me explain to you. Charts are a graphical representation of every day's, every period's price movement. So typically price moves in numbers, let's say 1.10, 1.28, 1.50. So throughout the day price is changing frequently. So if I give you a list of whole day's price movement, then it becomes very complex for you to understand that what price was at the open, what the price is in the middle of a session, and what price is at the close. If you plot this data on a particular chart, then it becomes very easy for you to understand that okay, the price has moved up in the first 2 hours of a session and then it dropped 50%, then it again continued the up move in the next half of the session. So chart helps you to read price very easily. On the chart vertical side you will see the price data, and on the bottom of the chart the time scale is plotted, that over a period of time this price movement has occurred. in a particular currency. Technical analysis is much science as it is art. Technical analysis have some scientific concepts like chart patterns, how to draw a trend line. There are many more. We will discuss in the next videos, but it is those concepts are science, but the application of those concepts is an art, and it's subjective in nature and based on the interpretation of the analysis. What it means that I am reading the same chart as you do, but the conclusion that I am drawing from that chart could be different from what you are analyzing. So technical analysis is subjective in nature and different conclusions can be drawn. That is why you have to deal in a probabilistic nature while trading with the help of technical analysis. Why technical analysis works? Technical analysis is based on an assumption that history always repeats itself. But I say that it does not repeats. It rhymes. Why? Let's see. People move the markets. We know that. All traders are transacting, and that buy and sell done by people like us is based on human psychology, and that psychology was same in the past, is same in the present, and it will gonna remain same in the future also. How? Let's see what are those emotional psychology that affect a trader and make him buy or sell. Nervousness, fear. When you are losing in the market, you are fearful it should not hit your stop loss, and that fear will result in irrational behavior that can make you sell a particular forex trade without sticking to your entry or exit rules. Overconfidence, when you win a series of trade consecutively, then you will become overconfident and you can buy or sell without your setup. Regret of holding a losing trade and not booking loss at the stop loss level. Hope of a losing trade that it should come in profit. Fear of missing out. If you are influenced by or other trader and you are acting based on someone's opinion, then it could trigger a fear of missing out and you can enter into a wrong trade. And greed. The greed factor was there in a human nature like 500 years ago. The greed is same and the greed will gonna remain same in the future also. So these emotional factors can make you buy or sell in the market, and that buy or sell forms some kind of patterns on chart, and those patterns can convey a message and you can use it. This is why the technical analysis works. A very famous trader, Jesse Livermore, has quoted that all through time people have basically acted and reacted the same way in the market as a result of greed, fear, ignorance and hope. That is why numerical formations and pattern reoccurs on a constant basis. Focus on the word reoccur on a constant basis over and over with slight variation. As I said, the history does not repeats itself. It rhymes. Why? Because whatever pattern has occurred in the past could have different buyers and sellers from the present structure that is forming. So market are driven by humans and human nature never changes. Whatever you do, those emotions, overconfidence, greed, fear, regret, they will gonna same. That is why the technical analysis has worked in past, it is working in present, and it will continue to work in future also. But still you have to deal in a probabilistic way. Let's understand types of chart and how a chart is formed. The first type of chart is line chart. As you can say, the name reflects, it is plotted with only a single line, and this is the most basic form of presenting price movement. and line chart is created with only one single data point, which is closing price. Closing price means if you are on a daily time frame, then the closing price will be the last price of the day. A series of daily closing prices create a line on chart and it will show you the basic price movement. It does not convey a lot of information, but it gives you the major price. It clears the noise and show you only important information. So majorly big players uses line chart because they need important price data. The second type of chart is Japanese candlestick chart. You can see on this screen the price is presented with the help of different candles, and this chart has originated in Japan in 18th century by a rice trader Homma Munehisa. He found deficiency in line chart because it is only showing closing price for the whole day, and he thought that what if I could understand that what is the opening price, what is the middle day's price, so he can take better trading decisions. So he invented these candlesticks that can give you 4 data points and that can help you a lot in taking rational trading decisions. So let's see how a candlesticks is formed. Formation of candlestick patterns. 4 data points are needed to form one candle for a period. Let's see how one single candle is formed and plotted on a chart. A candle have 2 elements. First is body, as you can see on the chart, and the second one is wick, or you can call it a shadow. Some people call it tail also, whatever. They all mean same thing. On a green candle's bottom, this point shows the open price. In case of Forex, it is the price at 9 AM, and then the price moved a bit down, mark a low price, and then moved upside from here till all the way to this high level, and then finally the price closed here. So this makes a full candle. This candle is bullish candle because the opening price is less than the closing price. Means in this whole day the price has increased. All of the bullish candles will have same type of formations. Similarly, in a bearish candle, the low and high price will remain same as bullish candle, but the open price will change here. The open price will be at the top of the body, and then the price has moved a bit up, marked a high level, and then sellers came into strength. They sold and pushed the prices down all the way to this low, and then finally when the price closed, it came a bit up and then finally closed here. So this makes a full bearish candle, which shows a negative movement in the price chart. Now that you have understood how a single candle is showing you price data, let's understand how you can use combination of these candles to know the mass traders' psychology and identify trading opportunities. Combination of several candlesticks are known as candlestick patterns. Let's see what are the types of candlesticks. According to me, there are only 2 types of candlestick that are important. Other than those 2 are only waste of time. Why? You must have heard of different fancy names of candlestick patterns like Marubozu, Doji candle, spinning top, bullish, engulfing, morning star, white soldiers. These kind of fancy candlestick patterns are impractical to remember, and it is very hard to trade in the live market. To take trades based on these candlestick patterns, it become very hard, and you become impaired while taking decision whether to buy or sell. So what I have done, I have simplified the candlestick pattern so that you can understand the market structure clearly and take decisions based on it. So first type of candlestick is momentum or trending candle. It looks like a full-sized candle. As you can see here, the candles are very bullish in nature and they are almost closing at their highs, right? So these candles are momentum. It shows that the buying strength is very high. The buyers have pushed the price consecutively. In each candle they have pushed the price higher and higher without any waste of time or anything. So it shows a strength in buying. So that's why we call them momentum, because it has created some kind of momentum in only one direction, which is upside. And second type of candlestick is ranging candle, or you can say a trading candle. Trading candle typically have less than 50% of their total. Trading candles have less than 50% body size in comparison to the full candle. As you can see in this image, the candle's body is less than 50% of the total candle's size. But here in the momentum candlestick, they have like 80% body size. And for the definition purpose, if the candle is more than 50% of the total candle size, the body size is more than 50% of the total candle size, then it will categorized into the momentum candle segment. Other than that, all candles are ranging candle, which do not have any momentum in them, and they are showing a lack of strength, which means neither bulls or neither bears have the control of the market. Let's see this candle. What happened in this red candle? The opening price is here and it made a high all the way up here. Then the price has not been able to sustain at the high level and it significantly dropped below, marked this low level, which is very low, and then in between the session, when the session closed, it moved all the way up here and finally closed it. So this total candle size, the total candle, and if you compare the body, it is just merely 25% of the total candle size, right? And all of these different other candle also, these other candle also have very less body size in them. So that's why they are ranging in nature. Means what happened if I decode this particular candle on a smaller time frame? Let's say we assume that this one candle is 1 day of price action. So if I switch to 30-minute candle chart, then how will be the price action? It would be look like this. This is the open price. It moved higher, then again it moved a bit lower, maybe moved a bit up and then down, and then at the close it closed here finally. So it is a range. It is a range. It's not trending in only one direction. Alright. So that's why we call them ranging candles. And whatever those fancy candles you have heard of, Marubozu, Doji, spinning tops, they all are just a combination of these two candlesticks in mind, and I will show you that how you can read any candle on the chart with the help of these two candlesticks. Levels of bullishness. We will discuss that how you can read any kind of bullish candles and understand the psychology of traders behind that candle. Most bullish candle. What does it show? It shows that the buyers have opened the price here and there is no wick, means open is equal to low. It shows that the buyers were so aggressive, the buyers had so much strength that the time they opened, they keep buying and did not let the prices fall. And all the way up here. They have pushed the prices up and closed at the high. It means 100% size of the candle is equal to body, and these body are highly bullish candles, and it shows buyers are too much aggressive. Second most bullish candle. Why this candle have second most bullish implications? This candle only have 15% body size. Still, why we are giving it a second place in the levels of bullishness? Understand this, that the price has opened at this level and sellers came into the market and they pushed the prices this much down. But again, at this level, what happened? Buyers came in and they thought that the price are too low and we should buy it. So they pushed the sellers all the way up to this high point, and finally they have closed this candle at the top, or you can say close is equal to high, which shows sellers were aggressive at the middle of the session or in the opening of the session, but at the end of the day buyers won and they pushed the sellers to the upside. Means sellers have to wind up their positions. This is why this candle holds the second most bullish candle. Third type of candle is normal candle, normal bullishness, which shows that okay, the price has opened here, but buyers were pretty much aggressive, but still there are some sellers. In this case, there was very low to no sellers, only buyers. But here there are some sellers and they have pushed the prices a bit low after the open, and again buyers came into the picture and they pushed the prices all the way up to here, which reflects a very good positive movement. And finally, when the session closed, the price was trading just near high. So this candle is a normal candle, or you can say a healthy candle, which had some sellers but mostly buyers. So that is why the body is around 80 to 85% of the total candle size. Neutral bullish candle. Why this is a neutral bullishness? Why? Because the price has opened here and initially the buyers have pushed the prices up, but at this point sellers came in, they pushed the prices to this low price. But again, buyers were not happy at this time, they had some strength left, so the price moved a little bit up and finally closed just around the open price, here just above the open price. So it says both were fighting, buyers and sellers, they both were fighting and no one won. But a bit of buying pressure was there even after sellers trial to push the prices down and down. They failed to do that, and buyers were also failed to keep the prices at the highs. So that is why this candle holds an undecision mode. Means the buyers and sellers both are having equal force and they are not able to move the market in any single direction. They have, after such efforts, they only manage to keep the prices in a range bound scenario. And the least bullish candle is just the inverse of the second most bullish. Why? Let's understand. Least bullish candle, you can see here, the price has opened at this low price. Remember, always whenever you see a green candle, open will always be at the bottom of the body. Whenever you see a green color candle, the open will be at the low of the body. This is open always. Otherwise the colors of candle will not gonna be green. Let's understand what is the psychology behind least bullish. The open is here, which says open is equal to low, because this candle has no wick, no lower wick. It means open is equal to low, and then after open the buyers must have pushed the prices to the upside till this point, but sellers came in and then they pushed the prices all the way to down here. The session closed with only 15 to 20% of body size. But this is still bullish because the sellers were not that much aggressive that they have pushed the prices below the opening price. So still buyers have some strength here, so they have not allowed the sellers to push the prices below the opening price. Means the sellers are not able to make a new low. This is why this is a very least bullish. It means whenever you see this candle on the chart, it shows that there is a weakness in buyers. This candle shows indecision mode. The buyers and sellers both have equal force. This shows buyers are good and healthy. This shows buyers are aggressive. And in this candle, buyers are super aggressive. There are no sellers. So, in this explanation, you have understood how to read a candle with very in-depth insights. And those insights can help you understand that how the majority of traders have traded till now and what they can do. So based on that, you can find an opportunity and take a trade. Similar to levels of bullishness, there are levels of bearishness also. So this is the most bearish candle, which shows 100% sellers. There is low to no buyer. And the second most bearish candle, the price has opened here. And red candles will always have open at the top of the body. So the price opened here, buyers came in, they overcome the sellers for some time, but sellers become much more aggressive after some time and they push the prices all the way down here and they made a new low which is below the opening price. So buyers were there initially, but sellers pushed them out of the market. Normal bearish, which have some buyers but mostly sellers. The price opened here and candle closed all the way down to near low price. Neutral bearish, which have equal buyers and equal sellers, but as this had a bearish body, you can say that the sellers are 55% and buyers are 45%, but averagely they are both equal. They both are fighting, and after the fight any one team will win. And in the case of stock market, it will be called as a breakout. Least bearish candle. You have a pretty good idea that why this candle is very least bearish. The price has opened here at the top and sellers pushed down the price all the way to this low, but buyers again came into the market and they recovered this fall and managed to close near the open, but they have not able to penetrate this opening price. So that is why there are good amount of buyers coming in as of now. Earlier there was seller, but now buyers are coming in. So this candle shows weakness in downtrend. I hope you have understood that how to read bullish candles and bearish candles. In the next video, we will continue to understand in-depth candlesticks and the real application of the patterns. Thanks for sticking around. If you found this video helpful, there's plenty more to come in our series on Forex and technical analysis. Make sure to subscribe to our community channels to stay updated. And don't forget, for all your trading needs, visit thrive.com. For more in-depth trading education, head over to thrivehub.com. Thanks for watching, happy trading, and I'll see you in the next video.